Going on? It is the 17th. It is a Thursday, not my normal Friday recording because I will not be able to record tomorrow. So I'm trying to make sure I get at least two a week out to everybody because I want everybody to at least know what's happening in the market. A lot of information going out there all over the place of what to expect because of the swings with the market and with the tariffs and all this thing, and I get it. I get that it's really, really, really confusing. And I want to hopefully at least give some data, at least from my perspective, so you can see from a different angle, right? You're going to get plenty of everybody else, but I look at things from different angles because of the experience I have. Those of you who don't know my experience, I've been at this since 1997, working with investors almost directly since 2003. I survived the dot-com bubble, the crash of 2008, COVID, all the madness that happened during quantitative easing, all this stuff. And I've been watching the markets every day since then. So what's happened this week that's influenced the market, other than the tariffs and all the freaking out, whatever, is you got, the Empire State Manufacturing Index doesn't have a whole bunch of movement out there, but it's showing that there is a little bit more going on. We had an anticipation of what to expect with that reading. It actually came in a little bit better. Import prices, a little bit better. Import prices for oil, that's also about flat from what they forecasted. Retail sales, which is interesting, that's gone up a little bit. Mortgage applications went down significantly. They were up huge last reading. Now they're way down, comparatively speaking. Monster swing. Why? Because rates went up higher than what they anticipated. Monster jump up as a result of that, right? Then you have retail sales, excluding auto, that was better than they anticipated, quite a bit better. Industrial production has dropped. Capacity utilization is slightly off of where it was, but it's pretty close to where it was before, meaning that people are using majority of their capacity, not quite to full capacity though. Inventories, business inventories, fairly flat from what the forecast was. The housing market index is also very flat from where it was and what it is forecasted. Another interesting thing. Housing starts, those are fairly, down just a little bit from what was anticipated. Anticipated 1.4 million. We got 1.324. So not far off of it, but quite a drop in the reading from the previous of 1.494. The Philly Fed index, that was also a big drop. Monster drop in that one from what is it? It was forecasted up, down -26, big move. Initial claims, that's down a little bit from what was forecasted and down quite a bit from the previous reading. So some jobs are happening out there. At least there's few people putting in claims for unemployment. So retaining jobs, continuing claims, those are up a tad. So there are some people who are continuing to claim the unemployment from what it was before. So it doesn't mean I don't know if they're looking, doesn't mean they're finding, not certain. So, with all that's happening, it does have its influence on the market. Everybody's waiting. We've talked about a lot of calls, when are rates going down? When should I lock when those rates go down? Guys, we had a blip. As far as that is improvement, and then it was gone overnight, almost immediately. It really lasted. The climb up out of that channel lasted 1, 2, 3 trading days. On the 4th trading, it just slammed down out of my barrier, which I'll show you in a minute. So what that means, when you're talking about people timing the market, there's a lot of folks that say, I'm trying to time it. I was listening to a podcast, and maybe already mentioned this, that there's an individual on there saying, hey, he's been trying to buy the dip since 2008. Go back and look at the stock market from 2008 to now. And he's been watching that, trying to buy the dip and never could. Judas Priest, it's not a matter of timing the market, period. It's a matter of the time you are in the market. Same with real estate. If you're trying to buy the rate going down and trying to time it, you're never going to do it. There's no such thing as timing. The only time you time it is when you're already in it. Time in the market. You will literally be at that point where it's the perfect time to buy because you're already in the market. So just be on the field. Just get there and get to work. So let me show you what's going on in the bonds so you can see what's happening. I got to tell you, I was right, been right with this whole pricing thing. I'm not trying to brag about it, just the reality of it. So here we are. Remember that whole barrier? I keep talking about that barrier up there. That's the barrier set by quantitative easing. The day they announced quantitative easing, the end of the day trading, this is the day they started quantitative easing. Those are those barriers. That's the value of the security at that point. Every time it hits there, it pulls back. Every freaking time. And look what it's doing. We drew this channel way back. We took the channel away because it got out of it. But then I put it back to see, wait a minute, this yanked it right back down. We had that swing it. Look, we're right in the middle of that sumbitch. We started on some support. This should be blue. but really I'm not paying attention to that right now. I'm just watching the lines. So it started on that support. I should have that as a blue line. I should have this as a blue line, reds up here as barriers, but we're right here all in the middle of the moving averages, right in the middle of this downward channel. So I think going forward that we can anticipate this to continue to go like that. Just my thought. I could be wrong at some point because it likes to swing out of it, but this is the direction we are going. Eventually, we may see, if we look at the whole thing, the thing as a whole, we will see it come down, just like it's done in other channels, gone down, come up, gone down, come up, hit there. It's going to go down. It's going to come up out here somewhere, get in there. And if you're in the market, already buying, you're going to take advantage of that when it hits these rates. The lowest rates we have seen in, oh, it's got to be, look at this. Lowest rates we have seen since April of 2023. That is through 2 years ago was September. There's a pattern here. Look at this pattern. When we got out with quantitative tightening, hit our bottom, this is our pattern. This is our pattern. Look at that. So know that we're going to get to that point where have these improvements when it gets up here, but that's where you don't wait. But you've got to be in the market to take advantage of those. You can't just sit back and wait and then see if you can make a deal at the time it gets there. Be making deals all the time. Okay? Don't try and make the market create the deal. Go find the deal that meets the market at that time, and eventually it'll be in right when it's perfect. So that's for you today. I'll be talking to you guys on Tuesday. Appreciate you. Have a really, really awesome weekend and a great Passover, all those things. Appreciate you guys.